Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into a topic that's been making waves across the Canadian financial landscape: the looming Canadian mortgage war. According to a recent report from the Royal Bank of Canada, the competitive landscape for mortgage renewals is about to heat up significantly. With little new origination activity in the market, banks are gearing up to fiercely compete for mortgage renewals, signaling a potential shift in strategies as they vie to retain their existing customers. This intensifying competition is primarily driven by the current economic environment where new mortgage origination has slowed down. With fewer new customers entering the market, banks are focusing on retaining their existing mortgage holders who are up for renewal. This shift might lead to more aggressive offers and incentives for these renewals, as banks aim to prevent their customers from switching to competitors. This scenario is crucial for mortgage holders as well, as it presents an opportunity to potentially negotiate better terms or secure more favorable rates. However, it's important to stay informed and understand the terms being offered. The Royal Bank of Canada report highlights that borrowers should be prepared for a more dynamic and potentially advantageous negotiation landscape as banks attempt to outdo each other. As we continue to monitor these developments, it's essential for both mortgage holders and those looking to enter the market to stay informed about the changing dynamics. This competitive environment could lead to beneficial outcomes for consumers, but it also requires a keen eye on the fine print and an understanding of the broader market conditions. The recent changes to the mortgage stress test by the Office of the Superintendent of Financial Institutions, OSFI, have sparked confusion within the mortgage industry. Initially, in September, OSFI announced that the stress test would no longer apply to uninsured straight mortgage switches starting November 21st. This change was intended to ease the process for borrowers with uninsured mortgages to switch lenders without facing the minimum qualifying rate, MQR requirement, provided there was no increase in the loan amount or amortization period. However, as the implementation date approached, Assistant Superintendent Tolga Yalkin introduced a significant restriction that many were not expecting. During a question and answer session, Yalkin clarified that the exemption from the stress test only applies to mortgages moving between federally regulated financial institutions. This means that the stress test continues to apply for mortgages being originated by or transferred to provincially regulated institutions, such as credit unions and mortgage finance companies. This revelation has caused frustration among industry professionals who feel that the new restriction contradicts OSFI's earlier guidance. Ron Butler of Butler Mortgages voiced his concerns, questioning why there appears to be a bias against provincially regulated credit unions. He and others in the industry argue that this could imply a lack of trust in the underwriting practices of these institutions, which they find unjustified. Some in the industry are now seeking further clarification from OSFI, although the regulator has stated that all necessary information is already available in its published materials. Despite the confusion, some major banks like CIBC have already implemented the changes, while others remain cautious. It's important to note that the impact of this policy change might be more symbolic than substantial. According to the Competition Bureau, although 3 out of 4 borrowers are uninsured, only about 12.5% switch lenders at renewal. Ron Butler points out that the rule change is significant for those 12% who previously could not switch lenders, as it now allows them to shop for better rates, which is beneficial for consumers. Nevertheless, the percentage of borrowers affected by the restriction on transfers from credit unions is relatively small. Butler suggests that the real issue is about fairness, and whether federal regulators are undermining the credibility of provincial regulators, which could be seen as improper. Some observers believe that Yalkin's comments might have been more about jurisdiction than a lack of confidence in non-federally regulated institutions. OSFI, being a federal body, does not have authority over provincial regulations, which could explain the restriction. Further complicating the situation is the fact that many mortgage finance companies have adopted the stress test to facilitate selling their mortgages to federally regulated institutions. Maria Pimenta, Chief Operating Officer at Canada Guarantee, explains that while OSFI's guidance does not explicitly state the restriction, it is implied that the policy is directed at federally regulated institutions. She suggests that non-federally regulated lenders should look to their own regulators for similar policy changes. Overall, while the changes to the stress test present opportunities for some borrowers, the industry awaits more clarity on how these rules will be uniformly applied across different types of financial institutions. This situation underlines the complexities of mortgage regulations and the need for clear communication between regulators and industry participants. Let's turn our attention to the Canadian banking sector as we approach the release of fourth quarter earnings reports. Analysts are keenly watching how major players like Toronto-Dominion Bank and Bank of Montreal will navigate the economic headwinds and regulatory challenges that lie ahead. These factors are expected to significantly influence investor perceptions and the overall performance of the financial landscape. Toronto-Dominion Bank, in particular, finds itself under the microscope following a substantial fine of $3.1 billion in October for shortcomings in anti-money laundering compliance. This penalty has put TD Bank in the hot seat, with investors eager to see how the bank plans to address these challenges moving forward. Gabriel Dechaine from National Bank of Canada suggests there is speculation that TD might offer guidance for 2026, which could provide investors with a clearer long-term outlook for valuing the stock. Manny Grauman from Bank of Nova Scotia echoes this sentiment, noting that constructive forward guidance would be advantageous for TD, especially given the current low market expectations. This highlights the importance of transparency and strategic planning in maintaining investor confidence amid regulatory setbacks. Another critical area of focus for the Big Six banks is credit loss provisions. These banks have been setting aside increasing amounts of funds to cover potential loan defaults, a trend driven by the ongoing impact of high interest rates on both consumer and business financial health. Matthew Lee from Canaccord Genuity Corp points out that while the credit loss provisions for Bank of Montreal might be challenging, they are not expected to fundamentally alter the investment thesis. Improvements in sectors like commercial real estate and transportation could offer some relief. Additionally, the potential economic implications of a Donald Trump presidency are shaping discussions within the banking sector. Analysts are particularly interested in how proposed corporate tax cuts and potential 25% tariffs might affect the banks. Furthermore, Canada's recent decision to cut immigration targets, resulting in a projected net reduction of 1 million students and temporary foreign workers, could pose challenges for consumer spending and economic growth, thereby impacting business investment and productivity levels. In this volatile environment characterized by high interest rates, stringent regulations, and possible policy shifts, investors and analysts are closely monitoring the Big Six banks' earnings reports. The outcomes will not only reflect the bank's resilience, but also provide insights into the broader economic landscape. Let's delve into the recent analysis from Toronto-Dominion Bank, which suggests that Canada is moving away from the edge of what was dubbed the mortgage renewal cliff. This term referred to the potential financial strain anticipated as millions of mortgages come up for renewal amidst rising interest rates over the next 2 years. Economists had warned that such circumstances could put a squeeze on homeowners, and by extension, the broader economy. However, TD Bank's latest findings indicate that Canadians are adapting to the higher mortgage rates more effectively than initially expected. The bank credits this resilience to the diligent efforts of homeowners who have been proactive in managing their finances. As a result, TD now estimates that the aggregate payments, the balance of Canadian mortgages outstanding by the middle of 2024, will actually decline by 1.2% in 2025, rather than increasing by 0.5% as previously projected. This is being seen as a significant easing of financial pressure. To understand how we reached this point, let's look back to the early days of the pandemic, when the Bank of Canada slashed its benchmark lending rate to 0.25%. This move led to a drop in borrowing rates, making it attractive for homebuyers to enter the market with low-cost loans. Fast forward 5 years, and these buyers are now facing renewals at much higher rates. Michael Davenport, an economist at Oxford Economics, notes that about 1.2 million mortgages, representing around 17% of the total outstanding mortgages valued at approximately 350 billion Canadian dollars, are due for renewal in 2025. Despite the looming renewal wave, TD Bank is applauding Canadian households for their financial flexibility, attributing it to their own diligent efforts and the unexpected loosening of financial conditions. One of the key factors easing the pressure on homeowners, according to TD, is the heightened competition among lenders, which has resulted in lower than expected variable mortgage rates. Additionally, many homeowners have opted to switch from variable rate mortgages to fixed rate ones to mitigate the impact of payment shock. TD estimates that by the end of 2022, 14% of variable mortgages, valued at 520 billion Canadian dollars, were either converted to fixed-rate mortgages or were prepaid. Maria Solovieva, an economist with TD Economics, emphasizes that the renewal shock is less concerning than previously thought. Many of those renewing are individuals who initially opted for short-term deals and are likely to secure lower interest rates now. TD's assessment, based on its proprietary national mortgage data and other assumptions, supports a more optimistic outlook for the mortgage renewal scenario. Economists at Oxford Economics share this less ominous view of mortgage renewals. Tony Stillo, Director of Canada Economics, and Michael Davenport highlight that faster rate cuts by the Bank of Canada and more lenient federal mortgage lending guidelines have reduced the threat of a significant increase in mortgage renewal rates. The Oxford team anticipates that the Bank of Canada will cut interest rates by another 50 basis points at its next meeting on December 11th, adding to the easing cycle that began in June. They expect rates to drop to 2.25% by June 2025. However, they caution that fixed rates for mortgages may not decline much further, noting that the average 5-year fixed rate fell to 5.4% in October, down from its high last year, but is expected to stabilize before potentially rising again in 2026. TD Bank also suggests that the financial relief from reduced renewal shock could spur consumer spending and economic growth. They estimate that the savings from this easing could boost annual nominal consumption growth by up to 1.6 percentage points in 2025, even as population growth slows down. On a related note, former Bank of Canada Governor Mark Carney has weighed in on Canada's immigration policy, suggesting that recent execution failures have led to the country taking in more people than the economy can handle. This has prompted the federal government to adjust its immigration targets, reducing the number of newcomers significantly over the next few years. This shift follows polling data indicating a growing sentiment among Canadians for reduced immigration. Shifting gears, let's take a closer look at the condominium market in the Greater Toronto Area, as reported by the Toronto Regional Real Estate Board, or TRREB. The third quarter of 2024 saw a slight dip in average condo prices, a trend attributed to relatively high borrowing costs impacting the market segment. According to TRREB, condo sales in the Greater Toronto Area were down by 4.4% year over year, with a total of 4,204 units sold in the third quarter. Meanwhile, the number of new condo listings rose by 10.6% compared to the same period last year, reaching 14,721 new listings. This increase in supply has provided more options for buyers and, consequently, more negotiating power, leading to a slight decrease in average selling prices. The average price for a condominium apartment in the Greater Toronto Area dropped by 3.3% annually, landing at $692,672. In the city of Toronto specifically, the average price was $713,801, down from $737,035 a year ago. TREB President Jennifer Pierce has expressed optimism, stating that as interest rate cuts begin to take effect, more renters might transition into home ownership, initially benefiting from lower borrowing costs and home prices. Looking ahead, TREB's chief market analyst Jason Mercer anticipates that as the market absorbs the current inventory of listings, conditions will tighten, potentially leading to renewed price growth. However, he notes that this shift may become more evident as we move through 2025. This perspective offers a balanced view of the market, acknowledging both the current challenges and potential future opportunities for growth. It's important for prospective buyers and investors to stay informed about these trends and consider the broader economic conditions that influence the real estate market. The current landscape, characterized by high borrowing costs and increased listings, presents both challenges and opportunities for those navigating the condo market in the Greater Toronto Area. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.